Like all energy markets, electricity markets are imperfect. This means that without regulation, they will not reach an optimal outcome from the point of view of society. Let's look at the three main types of market failures. There's the missing money problem when a price cap is implemented. There are external effects, and especially during the energy transition, revenue uncertainty can also play a big role. Here we see again the price duration curve in green that we also saw in the previous clip. The curve indicates all the electricity prices in a year, sorted from high to low. Now let's consider a certain power generation plant, like a gas plant or a biomass plant. The generator's operating costs are indicated by the horizontal dotted line. The orange area indicates the surplus of the generation plant, the difference between its market revenues and its operating costs. The orange area therefore indicates the part of the revenues that can be used to recover investment costs. If the orange area is larger than investment costs, then the generator is making a profit. If it is expected that generators will make a profit in the future, this can also be expected to attract new investment. Then, with more power plants entering the market, prices would drop and a new market equilibrium would develop. Therefore, in a market, we expect that in a long-term equilibrium, the orange area just recovers the capital costs. On the other hand, if the government implements a price cap, as indicated by the horizontal dotted line, then the revenue of the generator would be lower in this graph. The solid orange area would be the lost revenue. So now, actually, all power generators would receive less money from the market. That means that they're less likely to recover their costs, and therefore a new generator would also not be built as quickly, because now new generators would expect a lower revenue. So this is the problem with price interventions in markets. They look like they're attractive to consumers, but if they discourage investment, then they may actually not be beneficial to consumers at all. There are solutions, though. For instance, if a capacity market is implemented in an electricity market, you can have a price cap because then the generator is paid in a different way. Let's now look at the second type of problem, namely external effects. Many markets are characterized by external effects, such as pollution and climate change. An external effect of a transaction is an impact on a party that's not directly involved in this transaction. So if I produce electricity with a coal plant and I sell it to you, but I create a lot of CO2, neither of us pays for the damage of those CO2 emissions. A solution to this problem is to raise the price of electricity. Ideally, we would increase the electricity price with the social costs of climate change. You can do that through a tax. The tax would have to be set exactly equal to the social costs of these emissions. Then the buyer of the electricity would also pay for the damage that he causes. This raises the price of electricity, so he would buy less electricity. Or the consumer could choose to buy electricity from a cleaner generator, which might be cheaper now that the dirty ones are taxed more heavily. The European Union has chosen a different approach, namely a CO2 market, in which the government sets the total volume of CO2 emissions that are allowed, and a market determines the price of these tradable CO2 rights. This provides more certainty to the government that the CO2 emission target is met, but the price of CO2 can go up and down, which adds to investment uncertainty. The third issue that we will review is revenue uncertainty. Here, again, we see the price duration curve with all the prices of the year sorted from high to low. We already saw that the revenues above the variable operating costs are used to recover investment. However, these revenues are difficult to forecast. It's extremely difficult, if not impossible, to forecast electricity prices for a number of years into the future. And the same goes for the price of fuels and the price of CO2 emissions in the EU, or, for instance, the availability of carbon-free fuels in the future, like hydrogen or biomass. Now, a classic solution would be for generators to be financed with long-term contracts with consumers, because consumers would also want certainty, namely the certainty that they can have power. However, in Europe's liberalized markets, small consumers, which are a large share of the total consumption, have the right to switch provider on a monthly basis. Therefore, they are not a credible counterparty for a long-term contract. As a result, generators do not have a way to hedge their investment risks completely. This discourages investment, and so there's a risk of underinvestment. This can be a reason for government intervention. Now, the government may also get it wrong, for instance, by stimulating overinvestment in the electricity generation. So what is worse, under or overinvestment? Let's take a look at this graph. On the x-axis, you see the supply ratio. This is the ratio between the installed generation capacity and peak demand. On the left, the ratio is 1, meaning there's no reserve margin. Every time a generator has an outage, the lights go out somewhere. On the right, there's a comfortable 30% reserve margin of generation capacity over peak demand. On the vertical axis is the cost of power generation capacity. Now, let's assume that the more installed capacity there is, the higher the total cost of generation, as indicated by the line CG. On the other hand, the more generation capacity that is available, the lower the chance of outages, as indicated by the line CO. So the total cost to consumers is the cost of outages plus the cost of generation, CO plus CG. Somewhere there's a cost minimum, and that would be the optimal volume of generation capacity. However, it takes a number of years to build a new power plant, so at the time that the investment decision is made, we don't know exactly what the optimal volume of generation capacity is. This means that we're likely to get it wrong. We may create too much or too little power generation capacity. So if we don't know where the optimum is, what is worse from the perspective of society? Should we under or overinvest? Well, you see that if we build too much generation capacity, the social cost increases only slowly, whereas if we have too little, the cost of outages quickly increases the cost to society. So not knowing where the optimum is, it would be wise to invest a little bit more in the power sector rather than a little bit less. However, this is not what markets do. Private investors under high risk will tend to invest less to reduce their risk exposure. This is a reason for government intervention, for instance, in the form of a capacity market. Thank you for your attention.